Yeah, a bit of both. Definitely, I mean, 2 months ago, they basically hit all-time high representation of the index. And I think we highlighted that usually when that happens with a sector, that's the end of the story. And again, it was within a month, it was surprising how quickly it adjusted. They actually, I think Westpac peak to trough fell like 20% in a month. So you had a really quick adjustment. The valuations are a little bit more sensible now. But the reality is, they're still going to be constrained in terms of capital. Their payout ratios were as high as they could go. I think they did a capital issue just this week. And more importantly, the economic cycle in Australia is pretty stagnant. And so their earnings profile, all the banks are going to struggle a bit. And so typically what happens when you go to a peak valuation is that something happens, they get a bit of an adjustment, and then people kind of start to slowly adjust, and you'll get this slow re-rating back to a more normalised valuation. And if we have 2 or 3 years of maybe no earnings growth, then people kind of, hang on a minute, it's not as consistent a growth story as we thought. So I think we've definitely reached the peak valuation structurally, has come back. I'm not too worried about the downside, because again, the dividend yields in a low interest rate environment are pretty good. But I still think our offshore banks have a better risk reward, because again, they're still lower valuations and they've got better earnings growth. So I suspect the next 2 to 3 years you want to be in offshore banks, not domestic banks. But having said that, as I say, if you pick up your dividend yield, that's still a pretty good return. Yeah, a little bit. The problem is people have been talking about it for like 2 or 3 years, and it just doesn't happen. So I think it's going to be a slow process when it does happen. My instincts tell me that because it's been so talked about now, that the first time it happens, people will just go yawn. The real trick is more down the track. Do we ever get an environment where they find themselves behind the curve because we've had such a long period of stimulation? And you know what, we might actually get finally people getting confident and starting to spend, and then it's like, oh, we need to adjust. That's more when you likely get an adjustment. So we spent a little bit of time, but to be honest, the mistake you constantly make over time is wasting too much time worrying about what's the economy going to do, what are interest rates going to do, etc. Just find the stocks when they're out of, they're giving you a good risk reward opportunity and lock them away. So now, having said that, we're very mindful. We've kind of been looking for opportunities that, and the reality is, as rates go up, they probably benefit initially. So banks, they get better interest margins, better loan growth, stuff like that. And longer term, it's a big anomaly. So at some point, there's going to be a big adjustment, which is why we're very cautious of anything bond related, particularly property. I think property has way over levered to pretty skinny returns. So I reckon at some point that's going to get a bit nasty. But time will tell. So, but bottom line, we realise it's an anomaly. Don't want to touch bonds. Any exposure needs to be variable interest rates. But if your business is giving you a satisfactory return, that's what you really want to focus on.